Thanks for attending today. Today we will go through some of the tax implications and practical solutions associated with people who want to leave the country. Essentially, as shown in the agenda, we'll work through both citizens who want to expatriate, give up their passport, which is very rare, and non-citizens who want to leave the country. A lot of non-citizens who are living in the country don't even understand that there is actually a tax when they leave under certain circumstances. We'll go through both citizens and non-citizens. We'll go through the expatriation tax as well as an inheritance tax that also is triggered by expatriation. And that's the first section. So for the first 25 minutes to a half hour, then we'll spend the second half on pre-immigration planning. That's people who are non-citizens, typically non-residents, that want to move to the States, either temporarily or permanently, without creating a lot of tax liability. There's a planning and a process that you have to really follow very carefully to ensure that you don't bring all of your assets into the US tax net. So let's get into expatriation. Essentially, what happens with citizens and long-term residents is that people become interested in avoiding worldwide taxation. The US is one of essentially 4 countries that says no matter where you earn income, wherever that may be on earth, you have to pay the IRS on that income. So you can imagine that under certain circumstances where someone, for instance, has a tremendous amount of income coming out of, like, let's say, Europe or South America, especially South America and Asia, because these are not treaty countries where we have an arrangement on income tax. And most of the income is coming from offshore, yet you're a citizen or resident of the US, you have to pay the IRS on all of that income. So it's a worldwide jurisdictional issue. The same is true on the estate tax. The estate tax is going to attach to all citizens and residents at a 40% rate above the exemption worldwide. So there is a crediting system involved where an individual gets a credit for tax paid abroad. And some of the countries actually have treaties where you can avoid tax based either on where the assets are or where the domicile of the taxpayer is. Sometimes it works well, sometimes it's a little choppy, doesn't work all that well. But what happens is certain citizens, and especially long-term residents, really would like to avoid worldwide tax by the IRS, especially if most of the income comes from abroad. So you get into this issue of, okay, how do I get out of this worldwide obligation? And that's expatriation. Essentially, you don't want to be a citizen anymore, or you don't want to be a long-term resident. So there's, you can renounce citizenship or residency and then move out of the country and avoid worldwide taxation. That's the idea. It's become very complicated. Many people who consult with us are very surprised by the idea that the US limits the movement of people and money. Especially people in prior generations, they are under the impression that people can move in and out of the United States. There's no issue. If you ever didn't want to be part of the United States, you could drop everything and move to a different jurisdiction. It's not the case. It's not the case. We have the expatriation tax. It was originally imposed by Bill Clinton under Section 877 of the code in, I believe it was 1995. it was a revenue generation attempt. So what had happened was the code allows for people who are non-citizens and non-residents for income tax purposes to buy and sell intangibles. Intangibles includes corporate stock. So on a micro level, to understand how historically this operated, you had someone from abroad who said, well, I have got this great manufacturing or business or similar business, I can expand to the States. So what I'm going to do is I'm going to create an entity in the US. I'm going to move to the US. I'm going to become a resident because I'm in a way going to be forced to work there or spend most of my time in the US, and I'm going to end up becoming an income tax resident in any case. That's going to be required for that status. I'm going to be moving toward a green card so that I can stay there most of the year and work in the States and develop this business. So the idea was I'm going to develop a business in a US entity. And then I'm going to return to my home country. The business has grown tremendously in value. I have it rolling, and I'm going to sell the business. The code says if you're not a resident or a citizen, this person is now returned to the home country. They can sell the stock, no tax. So on a general level, you have this avoidance of worldwide income issue. On a micro level, which was very common, you had an incentive to invest in the States by opening a business in an entity and then leaving, giving up the green card, right? Now you're a non-citizen, non-resident for income tax purposes, and you can sell intangibles at no tax. So Clinton said, I want to create some income to cover my budget. I believe this is what happened, and I was pretty young in 95. So what we're going to do is we're going to impose a tax, right? 877 was the original tax, and the way it worked was essentially if you do this little plan where you start this business or you come in and you become a long-term resident, you're here 8 or 15 years on a green card, and then you leave, well, you have to wait 10 years to sell the business in our example. So there's what's called the 10-year taint. And that was the original format. So people would come in, they do it still happened, but of course, this was the period during the Patriot Act. We had that obstacle, and we had some other obstacles, which slowed outside investment down somewhat. But you still could do it. You just have to wait the 10 years after your exit, and then you get your tax-free status. That still allowed for tax-free status. And so we politically this got moved around for years, and then it was considered, this is still the exit tax, these are general concepts here. There's also an inheritance tax that we'll get into. And eventually we moved in 2008 to the idea of, okay, we're going to have an exit tax. We're not going to allow people to wait 10 years and then get a freebie on the sale of the business, right? This slide goes into when you're first becoming considered a resident for income tax purposes and for estate tax purposes. Keep in mind on all this stuff, there's an underlying current. So you actually have to understand what an income tax resident is, what a estate tax resident. They're different things. So for instance, so to be taxed worldwide on income tax, you basically are here for more than half the year on a weighted average basis. So they take the last 3 years, they do a weighted average, or you here more than half the year. there's a cocktail party rule, which essentially says that if you're not a citizen and you're in the US for less than 120 days a year, it's kind of they're playing with the averages. You're not going to cross over substantial presence, so you will not be a resident, right? And then on the that's the income tax. On the estate tax, if you land here with the intent to stay, you're an estate tax resident. So it's unrelated to the substantial presence test of the income tax. You land here with the intent to stay, then all your assets worldwide are subject to the estate tax when you die. That's kind of a different seminar, but you're going to need that background to kind of figure out the perspective of how the exit tax works. This goes into how, when they start counting the days, because it's significant with respect to whether or not you're going to fall within 877, the exit tax rules. And essentially what happens after 2008 is that it's purely a green card issue. So it's the same for prior law, but it's super significant. In other words, you're here 8 of 15 years on a green card, right? So the reason that we even talk about the old rule, okay, in terms of being a full-time US income tax resident and that 10-year taint, is because it changed to, okay, now that you're going to leave, we're going to tax you when you go. That's the new rule since 2008. When you go, you are subject to tax. And that tax is immediate, as if you sold everything worldwide. But here's the thing. On the new rule, this is still the old rule. Let me get to the new rule here. Essentially, you have to be here 8 of 15 years on the green card. Here's the taint. Now, why is that significant? It's very significant because you can plan with respect to the 8 years. You can create the business, you can not have a green card, you can do all kinds of things to avoid that status and create build the business up, get out of the country, do what you need to do, give up the green card, and then you're not involved. It doesn't catch you. I think on the conservative side that they knew that this was going to be an advantage. It seems like a disadvantage because when you leave the country, you're immediately taxed under the new rule. But it's kind of an advantage because you don't get into this situation where you're subject to this 10-year taint. You just get out before and you're okay. The problem is that this expatriation tax essentially is going to apply to people, not citizens, but people who are here from other countries on a green card. They're just not aware of it. So the 8 years pass, and all of a sudden they're caught. They're done. Now they're expatriates because they've got all of this cash and assets in Brazil, and they're tired of getting taxed on it in the US, and they definitely don't want to pay estate tax on it. They consider themselves Brazilian, they're not US citizens, but they can't get out without the tax. So you have to get into planning after the fact. So anyway, one thing to keep in mind is in order to get covered by the law, you have to be a fairly wealthy person. If any of these tests are clipped, you are subject to the expatriation tax if you're here on the 8 years on the green card. So it's a $2 million net worth. It's a 5-year average income of $206,000, which is usually the clip. That has become not that much money on an average basis it's worldwide income. So it's really not hard to get that. If you clip that, you're subject to the expatriation tax. And then they have a net, a kind of a safety net catch of failure to certify tax compliance. If you're not in tax compliance and you haven't certified, you're subject to the expatriation tax, even if you have less than $2 million or less than the income threshold. On the mark-to-market regime, which is the new rule where it's an immediate tax when you leave as if you sold everything, there is an exemption amount. It's 888,000 for 2025. So the way they eliminate people just day to day on the street green card holders is through the exemption. I mean, if you don't have basically $890,000 liability, you're exempt. So this is really for wealthier people. That we deal with people with this all the time. Typically if it's an existing client, we decide at 7 years. I mean, are you going to stay, or are we going to go through the process of expatriation of the non-citizen, give up the green card, do the it's an dual immigration and tax process you have to follow, and then you've got no expatriation tax. You just return to the home country and move about your situation. If you have U.S. assets, you're going to have U.S. situs income. We then drop U.S. assets to the extent we can in a foreign entity. The entity doesn't die, no estate tax. So if you can catch it, you can really plan. If you can't catch it, we'll go through some possible ways to remediate the tax. Keep in mind also the inheritance tax. So that's the trigger, right? The exit tax is if you sold everything, you're here for the 7 years, 8 years. The inheritance tax is pretty interesting, actually, because I'm not sure. I don't think it's very well enforced, but it's there on the books. So the idea is that when you become a non-citizen, non-resident, right? Let's say you stay the 8 years on the green card, you become a non-citizen, non-resident, you can't funnel assets back into the States. You can't give gifts to the kids who stayed, because the kids always stay. Basically what happens is the parents come in with the option of leaving, which is absolutely fine if it's properly planned. But the kids typically stay in the States. Not always, but a lot of times. So the inheritance tax says, well, once you then now you pay your exit tax, you become foreign, you've got all these advantages now, because a foreigner is not taxed on gifts of foreign assets, not taxed on gifts of intangibles, even in the States. One thing about intangibles is that you can give them away, U.S. intangibles, like U.S. stock, during your life, but if you die with them, you're taxed. So the inheritance tax says, okay, once you paid your exit tax, you're out. If you funnel money back into your kid, you're subject to gift tax. And there's no credit on gift tax. Even foreigners get a $60,000 minor credit. None for gift tax, and that's an estate tax credit. So what happens is you get involved with encumbering the kid with the tax, which is really weird because our whole system is based on, if you give a gift, the transferor is liable, but not the inheritance tax, because the transferor is gone, right, out of the country. So now the transferee is liable to pay the 40% on the gift. It's a very strange rule. I've actually never seen it enforced, but it's on the books. I'm sure it gets enforced, though, when there's a general audit. So if someone's subject to, for instance, the mark-to-market tax on exit, it's a wealthy person, and money's gone back and forth back into the States, they're going to catch them on the inheritance tax, and the kid's going to be liable for the 40%. And this is some detail on the inheritance tax. There is a trust option where the foreigner can put money, even though they were subject to the exit tax, into a foreign trust, and the kid is not taxed on the inheritance tax until the distribution. This is more detail on that. I think we want to stick to the big pieces today because we've only got the 50 minutes. I want to try to more or less stay on time. Some of the exceptions, if it's a taxable gift, charities, potentially spousal transfers, you just have to be careful with spousal transfers. We get a lot of this where the exiting person wants to give to the spouse. That's totally fine, except when the spouse comes, then they're going to get hit with a higher exit tax. You see what I'm saying? So you got to be careful with the spousal transfers. This is some general here we'll get into on who's a resident, who's not a resident. These are you're the kid is the covered beneficiary essentially. The U.S. person who stays, or any U.S. person, is actually a covered beneficiary. If you've got a covered expat and they're putting money back into the States in someone else's name, you're going to incur that. The recipient's going to incur that inheritance tax. Very odd tax. Same idea to avoid the exit tax is just you don't want to be a covered expatriate. You want to get your net worth under 2 million if at all possible. You can create a trust before you leave for your kids, get net worth down. You can sell your personal residence. There's a sale personal residence exemption on tax. Well, what are you going to do with the cash? That's another issue. And then we can go through standard gift and estate tax planning. With some more detail on the inheritance tax. And that kind of wraps up. If you have a question, just type it into the box and Tony will let me know and we can cover any questions you may have on the exit tax. We'll spend the second half on pre-immigration planning.
We do have a question.
Yes.
So from a financial advisor, and he's wondering if the firm has a framework for consultation or in an advisory capacity to answer questions on cross-border planning situations. Do you have some type of framework?
Well, we have a lot of billing options, I guess, if that's the question. We don't charge for an initial interview, so if we want to have a Zoom or we want to have a sit down at the office, for 15 minutes, a half hour, we don't charge for that to get a flavor of whether or not it's a good fit, whether we can help the client, this type of thing. One attractive thing to financial planners and accountants that we offer is a flat fee. So if it's a strategy implementing an estate tax or a gift tax or a corporate tax strategy or an M&A transaction, we offer a flat fee. So we can gather the information, put together our idea of what we think is going to happen, what we suggest, and say it's going to cost X. And that's it. It doesn't cost any more, it doesn't cost any less. We typically would ask for a retainer and then we would get the matter out within 5 and 10 days. Otherwise, they can go by the hour, we can do a range. 90 to 95% of estate and planning clients go with the flat fee. So we have an interview, we send an engagement out, it includes a flat fee with a quote for the different strategies. Sometimes the client picks and chooses strategies, if that's okay too, and they pay the flat fee. That's it. That's our structure. Hope that answered the question. So the idea with pre-immigration planning is that we don't want to bring assets into the States, right? We don't want to intentionally, let's say intentionally, without guidance or negligently move into a higher tax jurisdiction, pay more tax than we need to. We want to leave stuff outside of the U.S. tax jurisdiction. As background, if you are a U.S. person, right now it's almost $14 million of exemption. So you have to be very wealthy before you're subject to a state and gift tax. There's also a non-reportable annual $19,000 a year. Above the 14 million, it's 40. the tax is 40%. So we typically deal with very wealthy people on this. What we get into a lot is people who are not citizens or residents are taxed at that same 40% after $60,000 of value. So the last thing we want to do, and it still occurs after all these years, I've been doing this for 32 years, it still occurs so much where people come in and they don't understand you can't invest in the US in your own name. Once you get over $60,000, if you die with that asset, there are some exceptions like bank accounts. You're taxed at 40% on the value. So you have to plan for that. One's like a standard generalized plan would be to create a foreign entity. That foreign entity doesn't die. It makes a C corp election typically and buys property in the US. That way, when you die, you're not taxed at the 40% rate. That's just a little insight. We do whole webinars and seminars, and I've written books on this, on how to avoid that. But it happens a lot. So you first have to determine your status. If you're a resident, you get the 14 million, 15 million next year. So it may not be a factor. Interestingly, we're now getting into this give and take where people want to be a resident. You never had that years ago, but they want to be a resident because they've got $10 million. They didn't do their planning. It's a difficult plan, for instance, or there's tax that needs to be paid to do the plan. They don't want to do that. So they establish estate tax residency, they get to 14 million. So they don't have the overhang of having to pay US estate tax when they die. But if they have 100 million, that's not going to help. So the idea is it's a worldwide income estate tax net. I had mentioned income tax is determined by your presence in the US. Estate tax, did you arrive here and do you intend to stay? Once you do that, worldwide taxation. There's a lot of differences between non-citizens and citizens, residents and non-residents in the way they're taxed. For instance, non-citizens who are non-residents don't have this idea where you can just give it to your spouse. A lot of misconceptions are out there where you have the spousal deduction. In the States, you can give anything you want to the spouse. Not only that, your exemption floats over to your spouse. So you can double up on the exemption with, it's semi-automatic. So you have this huge $30 million exemption, and yours is portable to the spouse. Non-citizens, non-residents, no portability, right? So we had a case, for instance, where you had a husband and wife, South American, bought a mansion, mom died unexpectedly, no portability. The mansion was worth, I think it was worth $6 million. $3 million was taxable. And they just had no planning at all. And they had to pay the 1.2 million in tax completely unnecessarily. But it had triggered, it was over. The idea, if you're not a citizen or resident, is that the IRS is only dealing with tax that's assets that are situated in the United States. They only tax things that are in the United States. Now, what's in the United States sometimes it becomes confusing. For instance, corporate stock, most countries deem corporate stock to be located where the certificates are located. The US does not. The US says if it's a US company, it's US stock. So you have to have that corporate stock if you're not a resident, if you're non-resident, non-citizen in a foreign entity. There's your minor exemption, no portability. Here's some basic rules. You have to give away that stock, that intangible. There is no tax on the gift, even if you're non-citizen, non-resident. but if you die with it, it's taxable at the 40%. Sometimes there's a treaty exemption. We're dealing with a treaty group now, where we typically would have foreign people buy all of their US property in a foreign entity to avoid the estate tax. If there's a treaty, sometimes you don't need that. For instance, if there's a domicile treaty, the domicile treaty generally says that the domicile where the person is living and intends to stay is the only jurisdiction that will tax that person, right? So on the income tax side, we don't have to worry about that if there's an income tax treaty. It's just that foreign country will tax them. US won't tax them under the treaty. Got to be careful though, because the income tax treaties are often different than the estate tax treaties. So if there's no estate tax treaty, you've got to make sure that those US assets are in a foreign entity. Because if they're not, when there's a death, the 40% hits. Here's some of the different, we can get you this seminar, this PowerPoint. But here's some of the different estate and gift tax jurisdictions. It's pretty limited, as you can see, in terms of estate and gift. The treaties are very limited to essentially Western Europe, Japan. So while you're a non-citizen and you're thinking of coming into the country, or you have big plans to come into the US, you want to start removing assets from your estate because you're going to become an estate tax resident, right? So one thing typically we would do is start giving things away or funding a foreign trust. We start funding a foreign trust. That's a foreign entity. It's going to have its own taxpayer ID number. It's going to be treated as a foreign person. But we've got this complex net of rules from the IRS with respect to them. So like I had said, you can go under a treaty and you can move to trusts. The idea being, okay, I've got this massive offshore wealth. I'm going to move it into a foreign trust that's not a US person. I'm going to move to the States, right? And when I die, I'm a US resident, but all the stuff's out. There's no US connection to it. Income section 679. 679 says it's mixed with 684. So 684 says if assets are moved, right, to a foreign trust, they're deemed sold on transfer, right? So that's tricky. That sounds like expatriation of assets. There's a tax. So all of the people who come in who are US people are like, well, I'm in America. I can move my assets wherever I want. No, you cannot. So the upshot of the 679 issue is that you have an American, typically there's an American beneficiary. Okay, if there's an American beneficiary, then 679 says, okay, we're going to call it a grantor trust. And so when you move those assets to the foreign trust, it's as if you didn't do anything. Okay, so the assets go out. It's as if nothing happened on the income tax side. There is no deemed sale because there's a US beneficiary. So we just have to keep one thing in mind. This is not for estate tax planning, because if we actually move it out of the country in a foreign trust and we complete the gift to, let's say, the kids, the kids are the beneficiary of the trust, we will not get a step up at death. So what that means is when there's the death of this grantor, that's when the mark-to-market income tax hits, which is a big tax typically. If you got a step up, I'm kind of unwinding the statute because it doesn't really go into this detail, but this is how it works. So if you got a step up, if those assets were included in the taxable estate, you get the step up and there's no gain. So it's no problem. You got a deemed sale, but there's no gain. So this is not a tax planning device. Same is true for the foreigner, right? If someone wants to come in and they say, well, what I'm going to do is I'm going to get all my assets out of the country. I'm going to drop them into a foreign trust. I no longer own them. So when I die, they're not taxed. And I've got all this stuff allocated to the kids. Well, there's a 5-year rule, right? I know this sounds crazy, but most people with more than $100 million who want to come into the States don't want to hear from Forster that they have to wait 5 years. So there's a 5-year rule that says, well, if you come in within 5 years of the transfer, we're going to put you back under 684 and 679, as if you made the contribution on the day, really, it's like the day before you came in. So if you've got US beneficiaries, you typically do, that's why you're coming in. There's no tax. It's as if you did nothing. But when you die, that's when the tax hits. It's as if you sold all those assets and all the gain is taxable. Here's the problem. All those assets are typically out of the taxable estate. That was the idea of the foreign trust. So there's no step up, and the mark to market pretty much obliterates those assets, taxing them on capital gains upon the death of grandpa, basically, who came in. So at that point, you can abandon US residency, right? And then you're not taxed on foreign assets. Or you can domesticate the trust. The problem with domesticating the trust is, so when you domesticate, you make it a US trust, becomes a US taxpayer, IRS is happy, they can kind of take everything out of it. The problem is, if you can't, you got to plan, because if you domesticate that trust, you're going to pull all the foreign assets into that trust. And if you've got foreign beneficiaries, they've got to pay US tax on those assets. Whereas if you had segregated those foreign assets out in a separate foreign trust for the foreigners, they pay no US tax on it. I can work through all these steps. Essentially, US people can create a foreign trust. It's not a tax planning device typically. It's just treated as them. If they get the step up on the assets at death, there's no mark to market. Foreign people coming in, if they don't wait the 5 years, it's as if they fund that trust as a US person when they come in. The problem is they've given the assets away. They don't get the step up. So there's the mark to market at death. That's it in a nutshell. And some of this is some basic tax background. There's significant compliance requirements once you have a US person with a foreign trust. It's the 3520. There's all kinds of foreign FATCA and FinCEN reporting on foreign accounts. It's pretty onerous, but I mean, with the right CPA, it's no problem.
Gary, we have a question.
Sure.
Is a US 401k converted to an IRA taxable in Spain to an expat?
Well, so if you're an expat and you have a US asset, the IRA does count. And so the mark to market tax occurs on the IRA assets. It's more complicated. It's an excellent question, actually, because there's actually a special section for deferred comp other than typical stocks and bonds and real estate, which is just bam, you're hit with the capital gains. So under those special rules, yes, you're hit with the tax when you leave. But there is a means by which you can extend them on an installment basis. But yes, it is caught. Whether Spain taxes them, what'll happen typically is you'll have to pay the tax as if you sold the assets. You'll no longer be taxed by the US, and then you would have to consult Spanish counsel because typically the treaty benefits would cover you. But because you did the expatriation, now Spain's going to try to latch into the income. I've never seen that issue in Spain in 32 years. But yes, on the expatriation, and will Spain typically tax it? Yes, very onerous tax system in Spain. It's moved to that over the last 30 or 40 years. It's quite a large government. When someone's here and they decide to stay here, and maybe they've said, well, I've got way too many assets. What do I do? I figure I'd close out the last 5 minutes. Well, they're just like a US person. So now what we do is we try to give assets away and keep the income, which allows the assets to go out under the $30 million threshold now. And if we keep the income, we can reduce even something like 50 million, 100 million, way down. But you've got to spend the income. People are very shocked when I say that. So you got to spend the income. If you don't spend the income, you save the income, you're going to get taxed on when you die on whatever you're investing in. So that's a grat. So you basically pick an amount of time that you're going to keep the income. That will reduce the value of the gift. And then you have to outlive the grat. Right? If you don't outlive the grat, all the assets come back into the estate. It's the same as true. It's a similar platform for a sale to what's called a defective trust. So you sell the assets to a trust that you pay the tax on. You sell it out. You take a note back. What's nice about that, about one of the things that's nice about the sale is, so the assets are out, and the note gets paid. It can be interest only for a while. There has to be 10% seed money that is gifted to start the process on paying back the note, right? But if you die before the term, it doesn't come back into your estate. Only the remaining note is left in the estate. There's some interesting things with grad. This is really domestic planning, but it's something that a lot of the foreign people that come in at some point do anyway. There's almost always on wealthy people some leftover assets. So we do the grad, we do the sale. The Cupid can be very interesting. That's where you transfer your residence or your vacation home into a trust. You keep it, same idea, you keep a period of years. So you keep 10 years, you have to outlive that 10 years. But that retained interest wildly reduces the value of the gift, such that you can almost get it down to no gift. So it's very significant, the grat, the sale, the Cupid, with respect to these residences on an appreciating asset. So you can do the grat or the Cupid as a long-term kind of gift, which is a great idea a lot of times. Some of the drawbacks are if you're kind of just over the exemption or you're not sure, you have to be careful because you don't get the step up at death. Like this gift goes in and that low basis stays in to the trust while the grat, the Cupid, the sale go on. You don't get that step up in basis. There's still a gift that's involved. Actually, not the sale, but the grat and the Cupid. But it can be used like for maybe only 3 years or 4 years if we think, hey, we're going to do a tech offering, for instance. We've done this a number of times, and we could have a huge appreciation. Well, once it's out, it's out. You still only get this annuity for 10 years, but the value shot up way over the taxable exemption. It's out of the estate. There's no estate, and there's never an estate tax under current law. You can go many generations, and you've gotten that stock out. And so after immigration, these are some of the strategies that are basically domestic strategies. And here are some of the advantages and disadvantages of the grat. And of course, the sale is not in this I think there's a mention of it, but there's no analysis of the sale in this PowerPoint, but we can get you an analysis of the sale as well. Here's the Cupert. We've had a lot of success with Cuperts. There are many practitioners are opposed to Cuperts because of this basis issue. We've had some tremendous success with the Cuperts. If the person is young, will outlive the term, essentially. One thing that what throws people off of the Cupert a lot of times is after the term, right, where you retain the mansion and you use the mansion, even though it's in the trust, you've got to pay rent to the kids after the term. So you can stay in the house, but you've got to pay rent into the trust after the term. It's another gift, which is great, but some of the entrepreneurial type people think that's hilarious that they're paying rent to the kids. And that's the program for today. We appreciate you attending.